After Friday's double credit rating downgrade, the dollar dropped, but not dramatically. Wholesale interest rates rose, but only slightly. So is it possible our first downgrade in 13 years won't affect us at all? To discuss this, I'm joined by Bernard Hickey of interest.co.nz. Morning, Bernard.
Good morning.
Well, as I mentioned, the market reaction wasn't as dramatic as perhaps might have been feared. Can we read much into that?
It was surprising. I mean, this was something we've been fearing for years, and now it's finally happened. But you've got to look at what has actually happened to the New Zealand dollar over the last 3 to 4 weeks, because the decision to downgrade was as much about what happened offshore as what happened here. And overseas, we've seen real turmoil that's driven the New Zealand dollar down from well over 85 cents to 76 cents. So there has been a reaction, just happened before the downgrade. But on the interest rate front, that's where a lot of people were nervous. The government was forecasting back in 2009 that this could cost us an extra 1.5%. But when you look at the move on interest rates and how low they are now, we're not seeing that flow through yet. So
is that to say we just haven't seen it yet and we still might?
Well, it is possible. It all depends on what happens on these international markets. If we see the turmoil and the financial disruption in Europe and the United States worsen, then the funding costs on our foreign debt could rise significantly. However, if it doesn't get any worse, we may not see the push through into mortgage rates that some people have feared. Although when you look at the credit default swaps, these are the measures of how much it costs to insure Australasian corporate debt, which means the banks, they have risen quite substantially in the last 3 to 4 weeks. So you could argue the markets had already forecast this downgrade and have pushed up our funding costs already.
You mentioned the international turmoil, and that is certainly what the Finance Minister and the Prime Minister have put this downgrade down to. Is that fair?
Yes, it is to an extent, but you've got to remember we've been warned about this for a long time now, that unless we can fix our current account deficit and our net foreign debt, that when the financial turmoil comes, then we'll be vulnerable. And it's come again, and we're vulnerable to a downgrade. So we got downgraded. We should have fixed these issues in a more aggressive way in the last 3 to 4 years. We didn't. Now we've been punished.
But they're trying to, aren't they? I mean, this was the whole premise of the 2011 budget, was to chart a course back to government surplus and avert a downgrade. Does that mean they've failed?
Well, essentially, Fitch and Standard & Poor's have said that we haven't done enough to fix our current account deficit. And when you look inside the details of the budget, Treasury itself is forecasting an increase in the current account deficit from 3–4% to over 5% in the next couple of years. Now, we can't afford to keep running such a big current account deficit. We already have a lot of foreign debt, and we're building in a structural foreign drain into our economy of upwards of 4–5% of money that has to go out every year simply to pay the interest on the old debt and pay the profit, the dividends on the profits that come to foreign owners.
Both of the credit rating agencies, Fitch and Standard & Poor's, point to our net foreign debt, not just isolating the banks or the household debt. Can we read anything into that?
Yes, because what they're essentially saying is that New Zealand's total debt really, in the end, ends up with the government if there's a real period of stress. As we saw overseas after the 2008 crisis, when banks failed, then governments had to take on the debt. Now, we've already seen the New Zealand government guarantee bank debt once before. The guarantee's not there again. The government has said, hey, we're not going to take on this bank debt if we get into trouble again, because we've got an open bank resolution policy. The only one in the world, by the way, that has this, which means that we would essentially let a bank fail rather than bail it out by the government. Now, the ratings agencies have said, that's interesting, but in the end, that private debt eventually has an impact on the public debt, and we're going to lump it all together.
So the credit rating agencies are saying they don't believe that plan by the government that includes not bailing out the banks, should they be in that situation?
Well, you can see they're a little bit sceptical, and Standard & Poor's did mention the situation with the banks here. And it's not tested. The open bank resolution system is new, I mean, it's unique in the world, and when banks get under stress, all sorts of strange things happen. No one's suggesting that's happening now, but we've been a little bit close to it before. In October 2008, when essentially the government had to put a retail deposit guarantee scheme in. Next time around, the government is saying we won't have a retail deposit guarantee scheme, and we're now in the unusual position of not having one when Australia does have one. So Standard & Poor's and Fitch are saying, nice idea, but let's lump them all together anyway.
We live in interesting times. Thank you, Bernard. That is Bernard Hickey from interest.co.nz.